We're not trying to reinvent the wheel here. We're just trying to accommodate a new type of risk into the way in which we underwrite loans. And if you keep it simple like that, it will be easy for real estate lenders. It will be easy for real estate operators. It will be easy for appraisers. The more complexity that you introduce into the system, the harder it becomes and the less scale you achieve.
Welcome to Sustainability Leaders. I'm Michael Torrance, Chief Sustainability Officer at BMO. On this show, we will talk with leading sustainability practitioners from the corporate, investor, academic, and NGO communities to explore how this rapidly evolving field of sustainability is impacting global investment, business practices, and our world.
The views expressed here are those of the participants and not those of Bank of Montreal, its affiliates, or subsidiaries.
Welcome back to another episode. I'm Alma Cortés Selva, Senior Advisor at the BMO Climate Institute. In today's episode, we'll be discussing green buildings and the findings of the Banking on Buildings Research Report, which analyzes over 20 years of global data to show how green and climate-aligned buildings outperform in terms of financial returns and risk mitigation. I'm joined today by Michaela Neuberger, the Executive Director of Affine Climate Solutions, and James Burrow, Director of Sustainable Finance at BMO. Welcome, Michaela and James, and thanks for joining us.
Thanks, Alma.
Thanks, Alma. Pleasure to be here.
Let's start with the big picture. And this is a question for both of you. What motivated the Banking on Buildings research? And then what makes this moment for you critical for the financial institutions? Why is it important?
So I start, Michaela. It started with a conversation between me and you 2 years ago, I think. It was a dark November day in Ottawa. We were at the Building Decarbonization Alliance conference. I think it was towards the end of the day. We were possibly having a glass of wine. And my aim has always been to kind of differentiate as much as possible the terms under which our bank is able to lend to clients who are doing, kind of building energy efficient, low carbon green buildings. And that's a bigger task than you might think. So as I recall, I kind of suggested to you, wouldn't it be cool if we could once and for all prove the link between green buildings and better credit performance, i.e., in simple terms, green buildings are more likely to pay back the full value of their loan to a bank. Therefore, they should be treated, differently in terms of the terms under which we would lend to those buildings. And, me being kind of lazy, I didn't want to do all that research. But luckily, you're head of a not-for-profit climate consulting group that has a fantastic track record of looking at this sort of stuff in great detail. So I sort of said, if we can get you guys some money and get a few of the other financial institutions together and pay you some money to do this work, would you do it for us? And I think that's where it all started off, right?
Yeah, that's right. It started off with a conversation. And for us at Affine, it also started off with many years of background in a real estate industry and realizing that many owners, managers, and lenders were still very skeptical that better sustainability or carbon performance was correlated with better financial performance. And so we really came to the Banking on Buildings program with a very practical observation that, owners who invest into energy efficiency and green certifications also see stronger net operating income through lower energy and operating costs and better tenant retention. And so we wanted to move the conversation, as James just mentioned, beyond the so-called green premium debate and ask a lender's question. How do sustainable attributes translate into loan performance and credit risk? And so it's really that gap in linking sustainability to underwriting that was the catalyst for the research.
And maybe the final thing I'd say is this isn't just about throwing discounts, on loans to green buildings because we want to be nice, we want to help the environment. This is about the core business of banking, which is to match risk to how we lend. This is what banks do all day long and have to do with regards to climate. It's maybe that we're just trying to get a little bit ahead of the pack on doing it for green real estate because we all have a passion and an interest in green real estate. But this is the core business of banking, and it's not about just throwing discounts out the door. It's about wiring our risk frameworks in the way that we measure risk to accommodate climate risk. It's that simple.
Thank you. You both brought it back to why it's important, not just in terms of sustainability, but just good business sense. The report mentions green and then also mentions climate-aligned buildings. Can you explain the difference and then why it matters?
Yeah, absolutely. And that's again, it's a good question because I've used that term now already quite a lot, climate aligned. And so when we say green, we're usually talking about buildings that meet certain environmental standards, such as energy efficiency or water conservation, maybe a certification like LEED. And those are all really important, but they don't fully capture what lenders need to understand about risk and resilience. And so climate aligned goes further. It's not just about being efficient today. It's about being prepared for tomorrow's climate realities. And so a climate aligned building, the way we have defined it, is low carbon across its life cycle, meaning it tackles operational but also embodied emissions. And importantly, it's resilient to physical climate risks like flooding or extreme heat. So in other words, it's designed to perform under future conditions, not just current codes.
One thought from me on that, because I speak to our real estate clients all the time, there's a lot in there. There's low embodied carbon, as in we're not using excessive amounts of high carbon concrete and steel, and maybe we're trying to build more, the buildings more out of timber. It's the daily emissions of greenhouse gas and energy use, and it's being resilient to wildfires and floods. That's a lot for real estate operators to think about, and that's quite ambitious. So Michaela, I don't know, correct me if I'm wrong, but for me, this is an aspirational target that we should be moving towards in kind of steps, a bit like the building code kind of upgrading, or the BC Energy STEP code kind of stepping up over time. This is a sort of 2035, 2040 objective that we're starting on the path down now. There are certainly some buildings that meet that criteria now, but to get all buildings there's a big long-term objective, right?
Yeah, that's correct, James. And I fully aligned with you on the point that it's ambitious. So we have criteria that we've developed as part of the Banking on Buildings program that define climate alignment for new construction. And also we're working on the existing buildings. So of course we need to differentiate between those two. And then we are offering sort of like a pathway to climate alignment and net zero performance that starts with a good, better, and best sort of sliding scale to bring building owners and the industry along.
I've mentioned the report several times. Michaela, what were some of the more surprising or compelling findings from the research? And then I'll ask also James.
Yeah, so absolutely. There were really three things that stood out for us as a team. So first is the consistency. So when we looked across more than 100 studies spanning 2 decades, different asset classes, different geographic regions around the globe, the pattern was really clear. Sustainability pays. The average value premium for green certified and energy efficient buildings range from about 3 to 11%, depending on the market and methodology. So the level of consistency over time is really compelling. And then the second point that really stood out to us, that was a surprising finding, but is the supply and demand dynamics. So one of the most interesting insights was how much context and the availability of green buildings matters. So in markets where green buildings are scarce, think suburban or secondary markets, the financial outperformance is amplified. So those buildings really stand out against conventional stock, which reinforces that sustainability is a good strategy for value preservation and risk mitigation. And so finally, maybe the third item for us was the clear link that we could make to loan performance. So we reviewed a dozen of studies from the US and Europe and found that energy efficient and green certified buildings consistently show lower default risk, NOI stability, and tenant retention, and sometimes even lower interest rates at origination. And so what's fascinating here is that lenders weren't explicitly pricing green attributes into underwriting, yet the performance advantage was there. So that's really tells us that there's an untapped opportunity for financial institutions to integrate these factors into their models.
Yeah, I don't think I would add anything. Michaela's highlights there were very much my highlights. But yeah, I certainly would call out the consistency. This study covered North America, but also looks at Europe, both the US and Canada. And the results were remarkably uniform, which is, certainly very, very interesting.
Following up to what you just said, James, then do you see any way where the findings can translate into practical actions for people in banking, for lenders, investors?
Yeah, no, absolutely. I think there's a few things. These findings are very, very suggestive around the credit performance of green buildings. So it certainly adds impetus on us as a bank to continue to think really hard about how we integrate that into our risk models. That's the ultimate goal, right? To match risk to return in the financial system. So, we at BMO have been doing a lot of engagement internally on this work about how to incorporate this into our risk models and borrowing practices. They studied over 100 academic papers spanning over 20 years in 3 continents. Like, this is a really robust body of evidence. So we feel confident at BMO to begin kind of implementing some practical steps with regards to that. But it also, there's a broader context external to the bank, right? There's real estate valuers, appraisers. They will go out and they will value a building and tell a bank how much they think is worth. And then we will allocate a loan, size the loan off how much the appraiser thinks that building is worth. And we'll also, in part price the loan off how much the appraiser thinks that building's worth. So if we get a really great body of evidence that indicates green buildings are likely to price at a premium, then we can change potentially how we lend to those buildings based off appraisers' advice. And I know Michaela and her team at Affine are leading some work engaging the appraisal industry around exactly that question.
The one example that the report cited Fannie Mae's green financing programs. For our listeners that may not be familiar with Fannie Mae and then their green financing program, they have various multifamily and single family options that incentivize energy and then water efficiency improvements, and then reward properties that have green building certifications. It's similar to James' comment, what lessons can Canadian institutions draw from these models? And then do certifications like LEED or Energy Star play a role in improving performance and then reducing default risk?
That's a great question, Alma. And I think what many people in Canada don't know is that Fannie Mae in the US launched green financing programs already in 2012. So quite a long time ago. And their goal was to make multifamily buildings more energy and water efficient. And the scale at which they have achieved that is impressive. So there's 2 programs, Alma, that you also mentioned that really stand out. There's the Green Building Certification Program, which offers a 10 basis point reduction in loan rates for buildings with recognized green certifications. And then importantly, also, there's the Green Rewards Program, which provides a 25 basis point reduction for existing buildings that commit to reducing energy and water consumption by at least 30%. And so this program even includes free energy audits and additional loan proceeds. What's remarkable is that over the last sort of 12 years, Fannie Mae has touched over 1.2 million residential units in the US, and that all led to the issuance of $132 billion in green bonds. So that's the largest known collection of green mortgage-backed securities. So beyond lower interest rates, participating buildings also benefited from higher loan-to-value ratios and lower default risk. So the financial case is really strong.
Michaela, do you remember that presentation that Bob Simpson, Bob, shout out if you happen to be listening down there in South Dakota, you invited Bob to come to a recent workshop, and a couple of things, stuck with me. And Alma, maybe this is kind of bleeding into where you're going to want to go with your next question. But what Bob said about their success was you keep things simple. You focus on simple, practical measures that have reasonable paybacks that building owners can take. It's not kind of changing the whole building around or trying to build the most sustainable building in the world. It's let's focus on the low-hanging fruit and the simple practical measures that building owners can take that make sense. And let's use existing financial products like mortgages or construction loans, but just slightly tweak how they lend into these projects. So in other words, the message for me was keep it simple, stupid. Like, we're not trying to reinvent the wheel here. We're just trying to accommodate a new type of risk into the way in which we underwrite loans. And if you keep it simple like that, it will be easy for real estate lenders. It will be easy for real estate operators. It will be easy for appraisers. The more complexity that you introduce into the system, the harder it becomes and the less scale you achieve. So that was something that, really resonated with me, really stuck with me, that Bob said in that presentation.
That's super interesting. And you were reading my mind, James. Then what is the low-hanging fruit for you? And then what are the next steps for climate-aligned buildings in Canada?
What's the low-hanging fruit for me? I think sometimes as sustainability professionals, sometimes we set our sights too ambitiously. We tell building owners, you need to completely retrofit your building. You need to do the envelope. You need to do the roof. You need to change out the heating, windows, everything. What I see in the market is something different. I see building owners replacing equipment and changing stuff out when it reaches end of life, which is naturally what we all do, right? If you have a new building or a new house, you're not going to kind of completely renovate it straight away. So in terms of keeping it simple, what I think is really important that financial institutions do, and even some energy services companies and things, is you present the green options compellingly and the way, useful ways of financing those green options at the point at which the relevant piece of equipment meets end of life. So you have to work on, the real estate operators' timelines, not your own timelines. You can also think about other kind of important inflection points, like when a client refinances their mortgages, right? Mortgages are cheap and they amortize over a very, very long time. So is it worth having the conversation with them then? Hey, is there any CapEx you want to do to your buildings? You want to make any green upgrades? Because we can roll them into the cost of the mortgage and you can kind of finance them over a very, very long time. So I think that's, in terms of practical suggestions, a couple of things that are top of mind for me, at least anyway.
I would add to that and totally agree with James that, starting with a low threshold of your energy and water or other carbon reduction savings is really good. It's really good to have a certain threshold, but not make it too ambitious so people can't reach it. And then I would also say it's really important for owners to contact financial institutions sooner. I think often financial institutions are being approached when the project is already half-baked and, it's too late to make any modifications and add that energy and carbon scope to the project. So the sooner, we hear this all across the value chain from, with all the stakeholders we work with on planning and implementing retrofits, for instance, but it's like the sooner you get together with all the various stakeholders, then you can get really valuable input and get the best outcome. But for us, really, what's important now in terms of next steps for scaling a climate-aligned lending? Well, there's sort of three things. The first one I would say is broader participation. So we would love to see more financial institutions join the Banking on Buildings program and commit to innovating financing terms. The second one is capacity building. Lenders need the tools and the training to integrate the research into underwriting. The third one is piloting. Really, it's when we pilot, that's when we really learn. So testing the better loan terms and the streamlined processes will help us identify what works for clients, for financial institutions, and what can really scale. And so bringing it back to Fannie Mae, their success was really because they did a lot of pilots at the beginning and they ironed out all the kinks. And they focused on the customer experience before going nationwide. So we believe that Canada can really take a similar approach, start small, learn fast, and then scale confidently.
Both of you, and with this question and in previous questions, mentioned partnerships, policy. What would accelerate this transition in terms of partnership and policy?
A big challenge, I'll just call it what it is, a big challenge in decarbonization right now of real estate is the relative costs of clean electricity and fossil fuels. Now, in some provinces, like say Quebec, for example, clean electricity is super cheap. That province is pushing forward really quickly in terms of real estate decarbonization, and heat pumps are just standard in many, new builds in Quebec right now. But you contrast that with provinces with more expensive electricity, where that electricity isn't necessarily generated by clean sources like nuclear or hydro or solar, and where natural gas and other fossil fuels are really cheap. That puts real estate owners who want to decarbonize in a really awkward position because, they're going against market economics, which is a really challenging thing. So, big picture, I think what would be most material for the real estate industry is if, Canada, and this is very aligned with the Prime Minister's priorities right now, is to build out the electrical infrastructure and the grid infrastructure and the generation infrastructure to, give the whole country, whether it's homeowners, commercial real estate operators, industry, cheap, clean electricity. That is the biggest thing that we could do. And honestly, after that, the problem sort of takes care of itself, in the interim, because we're asking for a lot there. That's a big, ambitious goal. Sure, you're going to maybe need some subsidies for heat pumps and certain technologies in certain jurisdictions. And you're going to need kind of support from not-for-profits or local government on helping real estate owners bundle together measures that help a building get to decarbonization, economically. So I think there are shorter term kind of more interventionist steps to help us get there. But big picture, the key thing is we need lots and lots of cheap, clean electricity and the grid to support it.
Yes, I would agree with James that also like a more stable policy environment that encourages, energy efficiency would be really good for the industry as a whole. But on the Banking on Buildings side for us, what we're really focused on right now is more partnerships and really bringing the ecosystem together. So as James mentioned, we've started to engage with valuators, industry groups like RealPAC and BOMA, and other financial and real estate associations. So these players really influence valuation standards and market uptake. So if they're aligned, lenders can scale climate-aligned lending faster and with less friction. So for us, collaboration and alignment are key because it's when policy, valuation, and lending criteria move in sync, the transition becomes business as usual.
Is there anything else that you'd like to add? You were very thorough, like on the conclusions.
For me, why I'm so excited to be this specific role at BMO in the commercial bank, where we lend to kind of companies that are not as big as publicly traded companies, but aren't small kind of businesses, is you're at the front line of innovation. And I think what we've described represents, the front line of innovation in sustainable finance. Like sometimes it's doing that hard, detailed, painstaking work to figure out, where the risks and opportunities are and how best to align the terms in which you lend, very, very standard off-the-shelf products like mortgages and construction loans, to kind of alter the terms of those core products.
Yeah, I'm personally really encouraged by the momentum that we're seeing right now. So there's a really clear opportunity to accelerate climate-aligned real estate, not just through lending, but also through new regulatory frameworks and valuation practices. And so reflecting on historically what we've seen over the last 20 years, market differentiation has been about energy efficiency and green certifications. So looking ahead, what we see at Affine is that the next frontier are buildings that align with net zero transition pathways. As climate and net zero commitments are still rising globally, but the supply of truly net zero buildings is still really limited. So this gap creates a strategic opportunity for financial institutions to now, act and strengthen risk models, improve loan performance, and build lower risk portfolios, while also gaining competitive advantage as first movers.
Thank you so much, Michaela. One more thing. Where can people get more details about the Banking on Buildings initiative and the Banking on Buildings report that we've been citing on this podcast?
So if anybody who's interested can just go to our website. That's Affine Climate, AFFINE climate.ca. And there's a description about the Banking on Buildings program, and it links to downloadable reports.
Thank you so much for joining us and sharing the insights from the Banking on Buildings project. Thanks for tuning in, and we'll see you next time.
Thanks for listening to Sustainability Leaders. This podcast is presented by BMO. You can find our show on Apple Podcasts, Spotify, or your favorite podcast player. Press the follow button if you want to get notified when new episodes are published. We value your input, so please leave a rating, review, and any feedback that you might have, or visit us at bmo.com/sustainability leaders. Our show and resources are produced with support from BMO's marketing team and Puddle Creative. Until next time, thanks for listening and have a great week.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer